It is important to note that anytime there is an accounting estimate, either an asset or a liability is affected in the financial statement or the financial position. For example, depreciation reduces what non-current assets, whereas provision for lawsuit increases liability. So his lawyers told him that he should make some provision. So the attorney balance sheet must spending liabilities. Therefore, whenever there is a change in accounting estimate, there will be a change in value of an item on the financial statement. Okay. A change in accounting estimate can therefore be defined as an adjustment of the carrying amount of either an asset or a liability or its related expense, resulting from reassessing the expected future benefit and obligation associated with that particular asset or liability. So please, if it is future benefit, it is an asset. Okay, if it is obligation, it is a liability. A change in accounting estimate may become necessary if changes occur in the circumstance on which the estimate was based, or as a result of what new information or more experience. Now, Meshach and Josiah, they are in court, and all of a sudden, Portia comes in, and Portia says that, Your Honor, I know Josiah, he is like that. He likes going around to bully people. Then the judge is like, then you know that your compensation is about to skyrocket. Okay. So first, initially, your lawyers gave you the estimate based on the fact that you are having issues with just Meshach, but now there are more information coming in. So it may change your your liability or your provisions that you have to make. 2, we can also cite depreciation as an example. So I think there is money in the transportation industry. So let's use our staff bus to do Accra Tema. You get it? Is it Accra, Kumasi Accra? That's, or let's say Sunyani Accra. Now there is a change in the circumstance or the basis that we said let's apply 10% because it was going to be staff bus. But now that we are changing its use, it means we may have to change it from 10%. The basis upon which we are applying the depreciation, or we came up with the depreciation rate, will now change. So changes in accounting estimate. So an entity may need to change an accounting estimate if changes occur in circumstance on which the accounting estimate was based, or as a result of what new information, new development, or more experience. I know most accountants like to use straight line method because it is easy. But sometimes, if you look at the nature of the asset, we advise that use reducing balance method. If the asset is going to, in your estimation, right, or from your professional point of view, you think this asset can last long, then it is very important to use like reducing balance method as compared to straight line. Because if you are using 20% straight line 5 years, that ends it. Like in the case of a furniture where we don't move it, like office table, we don't move it. It can last like 10 years, 15 years. So if you use reducing balance method, it is proper, or let me say it is ideal for that kind of item, right? So we will advise the accountant that, listen, if you do straight line there 5 years, now I depreciate real. Why don't you do this? Right. So as a result of more experience or coming from a senior person, then they may change the basis upon which they are doing their estimate. So by its nature, a change in accounting estimate does not relate to what prior periods and is not the correction of an error. The effect of a change in accounting estimate shall be recognized what prospectively by including it in the profit or loss statement. So the period of the change, if the change affects that period only, or the period of the change and future periods, if the change affects both. So if the policy affects just the current year, then it's going to be applied just the current year perspective. If it applies just the current, sorry, not just the current year and future periods, then we apply it at both years. So that's prospective application for him. Disclosure and accounting estimates. An entity shall disclose the nature and amount of a change in an accounting estimate that has an effect in the current period or is expected to have an effect in what future periods, except for the disclosure of the effect of on what future periods when it is what impracticable to estimate that effect. If the amount of the effect in future period is not disclosed because estimating it is impracticable, an entity may disclose that fact. In fact, all the standards, there are disclosure requirements. If you think you cannot even write anything, you have to disclose that. You have to even disclose the reason why you think you cannot write anything. So that's it for all the standard. One trick. I know it is not something that the examiner mostly like to examine, but I think I've seen it for some 2-3 marks. The moment you hear disclosure on any standard, the examiner is like, what's the disclosure requirement? Any standard. Nature. So if it is a related party, you talk about it, what's the nature of a relationship that exists between our company and the other company? Maybe we are associated companies, we are parent subsidiary, you disclose that one. Then amount. If in the case of a related party, their disclosure is going to be what? The related party transaction. Or we can talk about any outstanding receivables or payables, right? So amount. So for all the standards, anytime the examiner asks you about disclosure, at least the bare minimum, these two should come in. So if they ask you for 2 marks, you should be able to get it. Okay, so now let's look at errors. So the general principle in IAS 8 is that an entity must correct all material prior period errors retrospectively in the first set of what financial statement authorized for issue after the discovery by what restating the comparative amounts for the prior periods presented in which the errors occurred, or if the error occurred before the earliest of what the prior period presented, restating the opening balance as balance of assets, liabilities, equity for what the earliest prior period presented. However, if it is impracticable to determine the period specific effect of an error on comparative information for one or more prior periods presented, the entity must what restate the opening balance of assets, liabilities, and equity for earliest period for which was retrospective. So the same thing, retrospective restatement is practicable. Further, if it is impracticable to determine the cumulative effect at the beginning of the current year of an error on all prior periods, the entity must restate the comparative information to correct the error what prospectively from the earliest date practicable. So the same thing. If you're able to determine if you're able to detect the error and we're able to know the number of years, that is very practical. In my experience, it was PPE, so I only had to do the PPE computation and now compare it with the depreciation charge for each year. Okay, so if my computation is saying 5,000 and theirs was like 3,000, then there is a need to pass an adjustment of 2,000 to the opening balance in the current year. If mine is higher than theirs and there is the first one is when mine is higher than theirs, right? So they need to top it up. If mine is lower than theirs, then they need to reduce it, right? So once again, you will not recall all the financial statements. Some of the companies, their financial statements will travel to Denmark, to Germany, and all those things. And sometimes they don't want their donors or their partners to know that the accountant is not that solid, right? So they will not even mention it. But for us as auditors, we thought you disclose it. If you disclose it and they don't see it, then hallelujah. If they find it, you tell them that to err is human. Or whatever be the case, we are just helping you comply with IAS and IFRS. Okay. So disclosure of what? Prior period errors. If applying paragraph 42, an entity shall disclose what? The following. The nature of what? The prior period. Once again, disclosure and what? You are saying what? Nature. So anytime they ask you, what's the disclosure requirements under this standard? Just go straight for nature. Okay. So the nature of the prior period error for each prior period presented to the extent practicable, the amount of what? The correction for each financial statement line item affected. So if it is PPE, you talk about it. There were errors in PPE figures from 2014. You disclose it. If it's IAS 33, that is earnings per share. If IAS 36 applies to the entity for basic and diluted earnings, you also have to do it to look at it. The amount of the correction at the beginning of the earliest prior period presented, and if retrospective restatement is practicable for a particular prior period, the circumstance that led to the existence of that condition, and also a description of how and from when the error has been what? Corrected. So it has been corrected from 2012, 2025, 2013. You have to your mandate is to just what? Go ahead and disclose it. So in summary, okay, accounting policy, uh, estimate. So accounting estimate, then errors. So prior period errors. Okay. So retro, prospective, then what? Retro. Just that for the retro ones, where it is impracticable to go back, then you have no other option than to apply what? Prospective. In summary, that's it.